Trinidad and Tobago, and welcome to the Bourse Report. Well, last week we touched on local equity markets and what investors are cautiously referring to as perhaps a revival or turnaround for local stocks. Today we're taking a look at international markets and what would have transpired in the first 6 months of the year, and it makes for a fairly good reading for investors, notwithstanding a somewhat choppy start to the first 6-month period. Now, what can investors expect in the next 6 months ahead? Let's take a quick look at that. Turning firstly to US major indices, we can see that there was somewhat of a roller coaster ride in that first 6-month period. Of course, driving this would have been tensions in the Middle East and disruptions ultimately to key energy supply choke points across the globe, particularly in the Hormuz Strait, and that would have led to a fairly heightened uncertainty over that first 3-month period. We can see that the S&P index, for example, would have fallen to just around a 7% low decline over that first 3-month period, with a subsequent bounce in performance over the next 3-month period to ultimately close that first 6 months or first half of 2026 up 9.6%, the S&P 500 index, of course, in that tealish color. Dow Jones Industrial Average also up just around 9%, while the NASDAQ Composite would have also advanced closer to 13% overall. Now, what would have been the major driver? Well, as mentioned, energy uncertainty and concerns, and supply concerns in particular, and we can see that reflected here in this particular graph, which would track the S&P 500 index in that tealish color versus West Texas Intermediate crude oil prices. And as we can see, there was a fairly negative correlation or inverse relationship between the price of oil as well as the index movement or index direction. And you can see that negative 7.3% decline for the S&P 500 correlated with a fairly steep increase and almost 100% increase in the price of crude oil, with that subsequent mean reversion, if you would like to call it that, of crude oil up just 21%, and we're using that somewhat cheekily, with correlated to or inversely correlated to our subsequent recovery in the S&P 500 index, rallying from the middle of March, or the end of March rather, from that low point of negative 7.3% up to just about that 9.6% gain at the half-year period. Now, when we take a look at the sectoral composition or sectoral performance of the S&P, we can see there were some major gainers as well as losers. On the positive end of the spectrum, we can see that technology was up just about 32%, of course, driven in large part by the AI boom, as well as industrials and energy up 19.4% and 18.8% respectively, of course, driven by that supply chain uncertainty. Materials also up just about 12.1%. Real estate was one of the surprise performers in a higher interest rate environment, up 9.1%. Consumer staples also up 6.9%. Of course, inflationary pass-through pricing power for consumer staples typically higher than more the consumer discretionary section or sector rather. So the consumer staples up just about 7%, while utilities were also up 6.2%. Now, at a broader regional level, we can see that there was also fairly significant performance building on the back of a fairly strong first half of 2025 as well. 2026 performance in that half year, as mentioned, the S&P up just around 9.6% in the US segment. Asia ex-Japan also up just around, well, a whopping 28%, following up on a 14.5% increase in that first half of 2025. Europe up 5.9%, following a very robust 22% or 23% improvement in that first half of 2025. Latin America up 10.8%, again, also following up a fairly robust performance in the first half of 2025 of about 25.3%. Now, these are all investable exchange-traded funds or ETFs, which you can trade at any of your broker dealers. The SPY represents the S&P 500, Asia ex-Japan represented by the AAXG ETF, IEUR representing Europe, and the ILF representing Latin America. Now, does that mean that investors should be looking externally, or international investors rather, should be focused on other regions other than the US? Well, when we take a look at the investment of, or an investment of US $10,000 over a 10-year period, we can see that an investment of that $10,000 in the SPY, which tracks the S&P 500 index, would have grown to actually just about $36,000 US. So more than triple the value of your initial investment. Whereas an investment of the same $10,000 in an ETF which tracks The rest of the world equity markets, excluding the US, would have grown to just about $19,000 US over that similar 10-year period. So certainly there is a very strong case for remaining very focused for international investors, at least on US equity markets as well. So what can investors expect for that for the remaining half of 2026? Well, resilient economic growth in the face of inflationary pressures is one of the more positive drivers. Of course, those inflationary pressures will lead to a lingering uncertainty in terms of interest rate hikes, and particularly in terms of US interest rate policy, and those remain two fairly elevated levels of uncertainty, which could influence equity markets as we move further into 2026. Of course, supply chain disruptions and geopolitical tensions remain on a simmer right now, if not at a boiling point, given recent stances by both Iran and the US in terms of resolving their conflicts. However, that seems to be a very developing and dynamic story on a day-by-day basis. So for equity investors who are looking internationally, these do lead to some key conclusions. Of course, maintaining your core US exposure based on long-term performance. Of course, you can consider diversifying by a strategic regional allocation on a case-by-case basis, certainly for shorter periods of time, capitalizing on that market volatility and trends. If you do have a preference for timing versus allocation in terms of your investment strategy at the international level, but of course, always maintain a long-term approach. Time spent in the market usually beats attempts to time the market. So that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. You can email us at invest@boursefinancial.com, and of course you can check out our website bourseinvestment.com, where all of our research is absolutely free, and you can catch this article on today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.